Hey everyone, I'm Steve. Welcome to the War Room for today's explainer. Listen, we are tearing straight into the mechanics of this violent market action today. Zero fluff, guys. None. We're breaking down the technicals, reading the tape, and figuring out exactly who is pulling the strings on all this volatility.
We're skipping the noise and diving straight into the hard data. The regular cash session volume is back, and man, it's carving out some fierce multi-asset crosscurrents. Time to get to work. Let's open the ledger.
All right, read this tape with me. You've got S&P futures trying to keep their heads above water, clinging to a really mild gain at 7,558. But check the rest of the board. Absolute massive liquidations. Spot gold just cracked under the pressure, dropping down to 4,385. Bitcoin took a brutal institutional flush deep below 74,000. So what's the real catalyst here? You got to look at the energy pits. Brent crude surged nearly 3% up to 94.81. The paper market is fighting a brutal war right now.
Now, to understand the true structural driver of today's tape, you have got to look under the surface at the fixed income desk. We are talking about the 30-year U.S. Treasury yields acting like a massive structural anchor on this market under Fed Chair Kevin Warsh's hawkish path. We're sitting at risk-free government bonds paying north of 5%. 5%! That is a monumental structural shift.
Here's the core tension driving all this chop. You've got this tech-led momentum trying to drag the market higher, right? But it's fighting tooth and nail against those 5% plus borrowing costs. Look, when government bonds pay you that much, the equity risk premium just gets crushed. Investors are literally being paid significantly less to take on stock market risk. I'm warning you right now, if these yields do not cool off, the sheer weight of borrowing costs will snap this paper momentum right in half, leaving the S&P highly vulnerable to a sharp valuation correction.
Okay, let's move over to the physical friction points in the Gulf, because these events could literally tear this entire tape apart. Track this rapid timeline with me. Number 1, early ceasefire rumors that gave the paper market a little relief. Yeah, those completely dissolved overnight. Number 2, fresh U.S. military airstrikes just hit an Iranian target near Bandar Abbas. Number 3, that triggered an immediate retaliatory strike by the IRGC. And number 4, algorithmic money instantly front-ran the headlines, sending Brent crude surging toward $95 on massive volume. The Strait of Hormuz remains heavily disrupted, and guys' global inventories are draining fast.
This powder keg sets up a completely brutal, high-stakes fight between the bulls leaning on big tech and the bears who are absolutely sounding the alarm. The bears are warning of a massive bull trap built right inside a structural stagflation cycle. They're pointing straight to sticky energy inflation, high consumer costs, and those rapidly draining global energy inventories we just talked about. In this kind of environment, equity buyers are highly vulnerable. If this energy shock persists, it is going to completely wipe out the weak hands.
You want hard proof of that bear thesis? $733 million. That is the massive capital exodus moving straight out of U.S. spot Bitcoin ETFs. I mean, that is a deep flush in risk assets, proving without a doubt that this heavy macro weight is actively breaking market participants.
All right, let's get into our professional trading directives, the lines in the sand.
To trade this without getting chopped to pieces, you need aggressive discipline. Do not let a single green candle make you sloppy. When we look at the S&P daily chart, price is managing to hold right above the 20-day simple moving average at 7,550. But the absolutely crucial point is right below that. Watch the 50-day EMA curling up near 7,410. That right there is our absolute primary line in the sand. As long as we stay above that 50 EMA, the intermediate uptrend survives. That is the level you watch.
Switching gears over to the Brent crude chart. Now this is where the real war is happening. It's sliced clean through its daily 20 SMA. Right now it is fighting tooth and nail, testing directly on its 50 EMA at this critical $95 shelf. Listen to me on this one. If that 50 EMA fails to hold on a closing basis, the trapdoor opens for a very deep retest of the 200-day moving average.
You know, if you really want to know what the ultimate smart money is doing while the rookies are out there chasing intraday ticks, just look at Berkshire Hathaway. Ajit Jain made it crystal clear they refuse to front-run rumors on marine war risks. While everybody else is out there panicking, they are perfectly happy sitting on cash. He said, sometimes doing nothing is the most aggressive trade you can make. Guys, that is an absolute masterclass in capital preservation. They are collecting guaranteed risk-free yields while waiting to price the risk entirely on their own terms.
So here is your takeaway for today. The ledger doesn't wait for latecomers. Keep your sizes small, keep your stops incredibly tight, and trade the actual numbers right in front of you.
Knowing the geopolitical powder keg and the relentless yield pressures we just mapped out, are you ready for the morning bell? Stay disciplined out there.